that we talked about, like, hey, there's a lot of other things throughout history that we can see that insurance companies have gotten through. And one of the biggest ways insurance companies deal with it is reinsurance.
Yeah. Yeah. So how does that work? Because like you've been having questions. My wife asked me, like, how's that going to work? What happens? And then always the follow-up, what's that going to do for my insurance or our insurance? And I actually had a client the other day, we're on the phone asking about that. And they're like, what do you think about the fires over there? And what's that going to do for our insurance here in Washington? And they're quick to say, hopefully it doesn't affect our insurance. Yeah. So how does that work? How does reinsurance?
So in a direct way, it's not going to impact us in Washington. In an indirect way, it will. So directly, like when an insurance company looks at their rates for Washington for 2025 or 2026, they're not going to go, well, we paid out X number billion of dollars in California, and so we have to raise the rates in Washington to make up for that. Like that, it doesn't work quite like that. But what does happen is insurance companies have reinsurance, so that it stacks layers, and there's different ways that they can build their reinsurance contracts. So one company might do a reinsurance contract where they're paying it's called quota share, where the insurance company is going to pay a certain percentage of the premium that they collect to the reinsurance company. And then, so like say it's a quota share of 30%. So they pay the reinsurance company 30% of all the premiums that they take in, but the reinsurance company is now also going to pay 30% of all claims. So then it kind of diversifies their risk.
Yeah.
They also have excess loss or non-proportionate, which is the way a lot of companies do it, which they just say, hey, we're going to pay the first $100 million of any single event. And if it goes over that amount, we're going to tap our reinsurance company, or we're going to pay the first $1 million of every claim. And if the claim goes over $1 million, then the reinsurance company has to come in and pay us back anything that went over the million.
Yeah.
And so and then they have a set rate that they're paying for that insurance, because it kind of works as like an umbrella for the insurance company.
Yeah.
Obviously, there's probably bigger numbers than $1 million, right? Because they're going to take care of the vast majority of smaller claims. Or they'll have like treaty insurance where they're going to have like, hey, at the end of the year, anything over a certain amount of our portfolio, you're going to cover. So there's different ways that they can build their reinsurance programs, and each company is going to have a slightly different way that they approach it. But ultimately, the reinsurance carriers are there so that way when you have a major event like this, and that's just something that they learned from Harvey as well. So then not only did they go, hey, geographically we have to disperse, but then they also started using reinsurance carriers to limit their total loss on a large loss.
Yeah. So
that way they go, hey, we're going to take care of all the small stuff. When we get into this big numbers, we got to have layers of insurance. And oftentimes it might be more than one reinsurance carrier. You might have 2 or 3 reinsurance carriers stacked up to get to your total amount that you need to have covered. And so then the reinsurance carriers come in and pay those differences. However, the reinsurance carriers are looking at you nationally and globally. So like something that happens in Japan that can affect one of these big reinsurance carriers will impact their total operating expenses.
Mm-hmm.
And then that could actually impact what they're charging for reinsurance in other areas, because they go, hey, we can't get all this money back out of Japan, but we've also lost a ton of money into state solvent. We have to, if we're going to operate next year, we have to raise our rates up to X.
Yeah.
And so when you see reinsurance carriers that are covering the states and they're like, hey, we're covering the whole country, if we have a massive loss in one area, it could impact the cost of reinsurance everywhere.
Right. So you're first, I guess, you're saying that insurance companies buy insurance.
Right. Sounds like a multi-level marketing. It's like insurance for insurance companies.
Or they bring in investors or partners to say, hey, we're going to cover the majority of the cost of doing business. And if and then through contracts say, we're going to cover the first X amount, or we're going to cover a percentage, and then you guys are going to help partner into this to keep us solvent, to keep the business going, which is probably new for a lot of people to hear that there's reinsurance companies.
Yeah. And I like to make people aware of it because the reinsurance is a huge part of the business.
Yeah.
It's a huge part in making sure that when you have something like, because if you hit 200 billion, I don't think we will, but if let's say it did hit 200 billion in California, the companies like big companies like State Farm, it could cripple them.
Right.
So you need to have that reinsurance carrier in place to where you're sharing the load. It's kind of like, it really is the concept of insurance in general, right? Because I always tell people, you buy insurance for what you can't afford. So if my windshield gets broken, like it sucks, but I could afford to replace my windshield. If my car gets totaled or I, put somebody in the hospital and change, getting sued for $1 million, like I don't have that to just pay out. Right. So I need to have insurance for those things. However, my premium that I pay to the insurance company isn't adequate to cover $1 million loss.
Yeah, you'll never pay that in premium,
right,
to offset if you were to get sued.
Right. If the insurance company has to pay $1 million out on my behalf, I'm never paying them $1 million in premium.
Yeah.
And so we have to be in a pool with other people who are paying money in who are not having those losses to make enough money for the insurance company to pay out that $1 million. So we're already pooling together. And then really what the insurance companies are doing is they're layering that and saying, okay, but we're also going to pool with other insurance companies that have a bigger, national and global stretch. So that way, when something really bad happens, we don't go broke.
Right.
Because, they go, man, we can pay 100 million. We could pay $1 billion. I can't pay, we were going to have a hard time coming up with $200 billion if that's the case of the LA fires. Right. So that's really what they're doing is they're pooling themselves together. So that way everybody stays solvent and stays relevant.
Yeah.
To be able to pay claims.
Like you mentioned, that reinsurance company then is looking at the farmer's risk as a whole, but then also looking at whatever other big insurance companies are buying off of their reinsurance and going, okay, what is the risk of Farmer, State Farm, Allstate together? So then it affects nationally.
Yep.
So what has happened in California, like you said, indirectly.
Right. It's not going to be a direct impact. It's not going to be because of California wildfires where you're going to see a 4% or 15% increase in your homeowner's premiums. But what you will see is you'll see indirect impacts where you're going to have reinsurance carriers are going to start to change their treaties or change their contracts and say, okay, we're going to charge you X now. You also are going to see like reinsurance carriers oftentimes we'll even look at a company's exposure and say, you're too exposed in these areas. So if you want us to reinsure you, you have to diversify your exposure.
Wow.
So reinsurance drives a lot of things that people don't even realize. So if a company goes, hey, we're no longer going to insure homes over $2 million. Well, that might be driven by reinsurance carriers who say you have too much of that and you got to lower your risk because of the total payout when something happens. Or if you have a lot of high concentration of your customer base in a protection class 9, the fire protection class in Washington, a 9 is almost unprotected. And so they might say, hey, you need to reduce that to a 30% of your business. And so then the company has to look at it strategically and say, okay, what areas are we not going to insure in anymore? Are we just going to cut all 9s, or are we going to cut 9s that are over a certain amount? So they have to adjust their portfolio to make sure that it fits inside of the appetite of their reinsurance carrier. In the same way, a customer, right, who has a homeowner's policy and the insurance company says, hey, we're not going to insure you unless your roof is updated every 30 years.
Right.
And now the customer has to go, okay, well, I have to adjust something to meet that so I can continue to transfer my risk to the insurance company. I have to adjust something that I'm doing so the insurance company takes that risk. And now because insurance companies also have insurance companies, they're adjusting their portfolios, adjusting their
That's
businesses
interesting.
to make sure that it meets with that bigger overall view of reinsurance. So
Right.
there's like layers inside of that creates complicated. It creates a complicated system in some ways, but it also creates a system that when you have Hurricane Katrina at 93 billion or whatever it was that adjusted for inflation, insurance companies can pay it all out and not go insolvent.
Yeah.